Hey there, parents, and welcome to Sisters for Financial Independence, where we discuss topics related to money, motherhood, and everything else in between. I'm Catherine Agupjon, and in today's video, we are diving into a topic that's essential for every parent: tax tips. Whether you're a new mom, expecting, or already have little ones running around, you'll want to stick around because we're about to uncover some game changing tax strategies that help you maximize your savings and put more money in your pocket. As a parent myself, I know how expensive it can be to raise kids. But did you know that there are several tax breaks and credits available to help lighten the load for your family? So in this video, we are going to cover 6 ways parents can save on taxes. Let's first do a quick review of how a tax credit works versus how a tax deduction works. A tax credit directly reduces the amount of taxes you owe, giving you a dollar for dollar reduction of your tax liability. So a tax credit valued at $1,000, for instance, lowers your tax bill by the corresponding $1,000. Now, for the tax deductions reduce how much of your income is subject to taxes. So, deductions lower your taxable income by the percentage of your highest federal income tax bracket. So, if you fall into the 22% tax bracket, a 1,000 deduction will save you $220. So, it's good to understand how this will all work when you do your taxes. Deductions can reduce the amount of your income before you calculate the tax that you owe, and credits can reduce the amount of tax you owe or increase your tax refund. Let's begin with our first tip. The best way to save money on taxes is to reduce your taxable income. Many people mistakenly think that the only way to save money on taxes is at tax time, but at that point, it is actually too late. What you want to do instead is figure out how to reduce your taxable income. Taxable income is the portion of your gross income that the IRS deems subject to taxes. Now, there are actually many ways to reduce your taxable income legally and quite easily. Of course, as with all things, the information in this video is for educational purposes only, so I do recommend that you speak with a trusted accountant to review your specific situation. I don't know how much you make, I don't know your income and any other family situation, so you want to be speaking with an advisor or a trusted professional to help you understand what the options are for saving you taxes for the long term. I'd also encourage that you understand how the U.S. tax system works. As a reminder, the U.S. is based on a marginal tax rate system, which means that the different tax rates apply to different income brackets. Many people mistakenly think that they don't want to make more money because they don't want to get taxed more. The issue with this is that they mistakenly think that all of the money gets taxed at a higher rate, when in fact, as income rises, each additional bracket of income is taxed at a higher rate, not all of the income. And if you can reduce income that is subject to taxes, you can save money immediately. The first thing I would encourage you to do is to review your employee benefits guide. This is whether you work in corporate, government, you'll want to see what benefits are available to you. In all likelihood, there will be some benefits that is available to you that will save you money on taxes or that will allow you to put money into a tax advantage accounts. Tax advantage accounts will allow you to save money on taxes today or in the future. There are a few ones that you've probably heard of. The first one are your retirement accounts. If you have an employer that offers a 401k, you can put money aside and help reduce your taxable income to use that money for the future. Another benefit that you might want to look into to help reduce your taxable income are your HSAs and your FSA. HSA is a health savings account and it is coupled with a high deductible health insurance plan. But when you put money into an HSA, it is a triple tax advantage account, meaning your contributions are tax deductible, so it reduces your income. The earnings grow tax free and if and when you withdraw it in the future to pay for qualified medical or dental expenses, you don't have to pay taxes on it. So it can be a great way to put money aside for future health and medical bills. The next benefit that I want you to look into also is the FSA. And these come in multiple forms. One is the health FSA and one is a dependent care FSA. I'm going to cover the dependent care FSA a little bit later because I think it is also a great way for you to put money aside for your kids. But with the health FSA, you basically put pre-tax dollars. So they take money from your paycheck, put it into an FSA account. It's a flexible spending account. And from there, you can use that money to pay for qualified medical, dental expenses, maybe over-the-counter medications, prescriptions, and so forth. So if you are expecting perhaps a large medical bill that's coming up, or you're going through surgery or anything else, it's good to have money in that account so you can draw on it. Now, when they put the money into that account, it is pre-tax dollars, so it reduces your taxable income. And as a family, if you have kids, I am sure you're going to the pharmacy pretty often. So having funds in that account that you are going to use anyways can be very helpful. Lastly, I want you to look at those benefits handbook guide and look for other fringe benefits. This can include educational assistance programs, adoption expense reimbursements, transportation cost reimbursements, group term life insurance. These are some of the things that you are already probably paying out of pocket for. So instead, why not save some money on taxes? Why not have them withdraw that from your paycheck and reduce your taxable income? So now, if you are a stay-at-home mom or dad or a parent, I would absolutely encourage you to sit down with your partner to review the benefits that your spouse or partner has access to so that both of you can review the benefits and sign up for the benefits that will work for your family, not just for the working parent. If you only have one income coming in, you want to make sure that income is as optimized as possible, meaning you are saving money on taxes, it's going to the right places for your family. If you are reading over that employee handbook and you are unsure of what it says, have your partner reach out to their HR partner and have someone walk you through what's available, because in the long term, it will probably save you a lot of money. Now, I spent over 10 years in the corporate world before I stepped away to take care of my daughter. And I will tell you that a lot of the benefits I signed up for saved me money on taxes, increased my savings in the long term. So you need to understand that the benefits your employer offers is part of your compensation, so you want to make sure you're taking advantage of them. Now that you've reduced your taxable income by taking advantage of those employee benefits or taking advantage of tax advantage accounts, it's time to look at potential tax credits that your family may qualify for. If you just welcomed a new family member, congratulations! You might be now eligible for some fantastic tax credits. We're going to discuss in this section the child tax credit, the earned income tax credit, and the child and dependent care credit. The first credit that might be available to your family is a child tax credit, or CTC. This is a non-refundable tax credit available to taxpayers with dependent children under the age of 17. The credit can reduce your tax bill on a dollar-for-dollar basis, and it might eliminate your tax bill altogether. Now, there are certain qualifications necessary to take the child tax credit. There are generally 7 tests you and your qualifying child need to pass in order to get the child tax credit. For 2023, the child tax credit is worth $2,000 per qualifying dependent child if your modified adjusted gross income is $400,000 or below, as a married filing jointly, or $200,000 for all other filers. Now, this credit could change every year, so you want to review the IRS new guidelines for how much credit you could potentially get in the next year or so. The next credit that you are going to want to look for is the earned income tax credit, which helps low to moderate income families get a break. If you qualify, taxpayers can use a credit to reduce the taxes that you owe and maybe increase a tax refund. There are, again, certain requirements for this. Post a lot of these requirements in the description so you can take a look to make sure that you qualify and meet all the eligibility criteria for applying these credits to your tax return. Another credit that you might want to look into is the adoption tax credit. And this credit lets families who are in the adoption process during the tax year to claim eligible adoption expenses for each eligible child. Taxpayers can apply the credit to international, domestic, private, and public foster care adoptions. An eligible child is an individual who is under 18 or is physically and mentally incapable of caring for themselves. There are, again, income limits to the amount of the credit, and it is a non refundable. It will reduce your tax bill but won't result in a refund, even when the amount of the credit is greater than the tax bill. However, you can carry the leftover credit forward and apply it to future tax years for up to 5 years. With regards to adoption qualified expenses, this will include adoption fees, court costs, and legal fees, which can add up, adoption related travel expenses like meals and lodging, and other expenses directly related to legal adoption of an eligible child. The next credit that you are going to want to look for is a Child and Dependent Care Credit, or CDCC, and it is a tax credit for parents or caregivers to help cover the cost of qualified care expenses, such as daycare for children under 13, or if you have a dependent or a spouse or a parent that's unable to care for themselves or some other dependent in your home. Now, the child tax credit and the child and dependent care credit sound very similar, but I want to emphasize that the child tax credit is a tax incentive for people with children. So, as long as the children that you are claiming meet the tests that I covered, then you can get the child tax credit. The child and dependent care credit is another tax credit for working parents or caretakers that's been designed to help offset expenses like day camp or after school care. Both credits have rules and qualifications, and you can potentially take advantage of both. Now, if you've sent your child to daycare, you know how expensive it is. You know camps during the summer add up. So you might want to consider this child and dependent care credit so you can get some money back for what you're paying for daycare. Save those receipts so that you can submit them and have something back from your taxes. Here is a listing of the care expenses that may qualify toward the child and dependent care credit. It's good to have these receipts on hand so you know how much you've spent on this type of care. This includes nursery school, preschool or equivalent programs for children below kindergarten, pre and after school care because they allow you to drop off your kids so you can go to work. A big part of this is that you must be working in order to be also claim this credit. Maybe you pay a care provider who watches your dependents outside of your home, like a neighbor. Maybe you have transportation that takes your kids from one place to another so that they can have some after school care. Maybe it is a day camp. So you want to make sure you are accounting for any fees, deposits, application fees that you are submitting to care providers or care services so you can get a credit for what you've paid already. The third tip that I would encourage you to do to help you save money on taxes is to make sure you get your child's social security number or an individual tax identification number because you will need this to claim parental tax breaks. The taxpayer, that's you as a parent, must have their child or dependent social security number or adoption tax identification number or individual tax identification number. And confirming a child's birth is the only way the IRS can verify that the parent is eligible for the credits and deductions that you will claim on your tax return. Now, I remember when I had my daughter, the hospital automatically asked if we wanted to get her social security number processed, and I immediately said yes. Have the hospital do it because what's going to happen after you bring home baby is that you are going to be sleep deprived. You are going to be so busy that you might forget to apply for the social security number. It's also easier for the hospital to do it because they have all the information. They have the birth information, parent information, and so forth. And what you'll just do is after the hospital submits it, in a few weeks, you'll receive your baby's social security number in the mail, and that's done. Now you can use that number to process whatever tax you need, or if you need to add them to your benefits at work, that's all been completed. Don't delay on this because you might forget. The fourth tip that I have for you to save money on taxes and make sure that you're taking care of your family is to look for the Dependent Care FSA. Now, earlier in this video, I mentioned FSA, and it comes in a few forms. One is the Health FSA, which allows you to put pre-tax dollars for health expenses like over-the-counter medication, prescription. The Dependent Care FSA acts very similarly, but the money is used to pay for daycare, before after school care, and is also pre-tax dollars. So it reduces your taxable income. Now, the Dependent Care FSA must be offered by your employer. So when you're looking at your employee benefits guide, you want to see if that's available so you can take advantage of that. What happens with the Dependent Care FSA is that they will withdraw money from your paycheck and put it into a unique Dependent Care FSA account. And what you can then do is write and request a reimbursement for any kind of daycare or after school payments that you've made. So they'll basically give you the money back for all of the expenses that you've covered for your child to go to daycare, preschool, or some kind of summer camp. Now, this is pre-tax dollars, so it will reduce your taxable income. Now, for majority of individuals who actually have access to the Dependent Care FSA, doing the Dependent Care FSA will get you more, as opposed to applying for the Child and Dependent Care Credit. For the year 2023, if you are married and file a joint tax return, you have $5,000 for the year to spend. So you want to be planning ahead next year when you enroll that you'll be spending at least $5,000 in these services. Otherwise, it is use it or lose it. So if you don't use it, you lose that money. But I'm sure you know that if you're sending a child to camp or daycare, those costs add up, and it's probably going to be more than $5,000. But you still want to do the math so you are taking advantage of this tax saving tip. So, a big tip when it comes to these benefits. Normally, you can't change your benefits until the new enrollment season. But if you have a child, if you adopt a child, if there's someone coming into your family that might qualify as a life event, you can change your benefits. So, for my parents out there, if you are about to welcome a child, whether through birth or adoption, this is a qualifying life event, which means you can add them to your insurance or change insurance. You can also enroll in this pre-tax program, the Dependent Care FSA, so that you can reduce and save money on those childcare expenses. It can be very easy to overlook signing up for these benefits because first few days you are going to be sleep deprived. So before that happens, I want you to mark on your calendars after baby is born, a few days later, that you are going to change enrollment. Enroll in this pre-tax program, this Dependent Care FSA, if it's offered by your employer, so that you can save money on childcare expenses and you can also take advantage of those other benefits that your employer has. Don't wait and don't sleep on it. Otherwise, you'll have to wait until the new enrollment period, which would be next year, to be able to take advantage. The fifth tip to help you save money on taxes is to start thinking about the future. Start thinking about what kind of education you want for your kids. And this might open up the doors for you to start thinking about funding a college fund. And the best option that is available out there will most likely be your 529 account. Now, unfortunately, when you put money into the 529 account, you don't necessarily get a federal tax break, but the money can grow tax-free and you can use it to pay for college-related expenses as well as certain exceptions, and you don't have to pay taxes on those earnings. So you can save money on taxes through there. Now, there is a whole range of options for you to choose from when it comes to 529 accounts. And depending on the state that you live in, you might get a state income tax deduction. So you might want to look to see if that can be something that you can use. You don't get savings in the federal income taxes, but you might save money on the state side. And a 529 is actually pretty flexible. And really, no one will ever regret that they save money into a 529 account. That money can be used for a lot of things. Yes, it will be earmarked for education, which puts the intention out there that you want the best for your child. The past few years, there's been a good amount of new legislation that will allow you to convert the 529 funds into something else. So you don't necessarily have to lock in your money into this education fund. So keep that in mind. The last tip I have for you to help parents save money is to think about the long term. If you have a business, think about how you can hire your kids so that they can save money in special tax advantage accounts to grow their earnings and save money on future taxes. As a parent, you also want to be thinking about taking advantage of a lot of these tax advantage accounts. There is something that you must understand when it comes to taxes. Ordinary income, the income that you earn from your W-2, from your 1099, is always and has been taxed at a higher rate. However, if you have assets, appreciating assets, and you go to sell them, as long as you hold on to those assets for at least a year, the tax on those assets and those capital gains will be so much lower than ordinary income. So you want to be thinking about building assets for yourself, for your kids, and for that transfer of wealth. Now, today, certainly figure out ways to reduce your taxable income, figure out ways to take advantage of the benefits offered through work, figure out ways to look at those credits and deductions to save yourself money on taxes. But think about it long term too. How else can you save your family taxes in the future? I hope this video has been helpful, and I really hope to see you next time. Subscribe so you get notification on our next video where we will talk about money, whether it's budgeting, investments, or just figuring out ways to optimize your family income. I would also check out this video where we talk about capital gains. It's good to understand how this is calculated so that you know how investments work and how you can make money off of those investments and how you can save taxes on those investments. And this video, if you want to review the basics of budgeting and using ChatGPT to help you. I will see you next time on the next video. Bye.